we look for founders who have a growth mindset. And a growth mindset is important. Being willing to grow, either to become a better manager, a people's person, a better coach to your employees. It's a crucial trait to have. Right? Just being there. And if you're not helping, don't get in the way. Right? If you raise $100 million fund, you need to make at least 3x. Right? It's 300 million. In a diversified approach in power law, after dilution, so on, you exit the company, you own about 5%. That means you need $6 billion of exits. You raise a $300 million fund, that's $18 billion. In this current state of development, do you see that kind of exits? No. So math is actually very obvious if you took the time to do it, right?
Jeremy is a co-founder of Tinmen Capital, a venture capital firm that invests primarily in B2B technology startups focused on Southeast Asia. I'd like to welcome you to the Front Row Podcast.
Thanks, Keith. Great to be here.
You spent 20 years in corporate finance, and you worked at the big firms like Morgan Stanley and Thomas H. Lee in the US. My question is, what did you learn from there? What were the skill stacks that you picked up during your time in those two firms, particularly, that helped you to become a better operator?
I think it started in my university days as well, and a little bit of time when I spent at Harvard doing my MBA in between jobs. At Cambridge, I really understood the power of first principles thinking. So let me just share an analogy with that, right? So my first exam paper, I literally studied for 45 minutes, didn't know what to do. Because I grew up in a system where it's 10-year series, question 3, what's going to come out, right? At Cambridge, the papers were different every year, right? What they're trying to do is actually to teach you, look, they know by the time you finish your engineering degree, 4 years, right, the tech will have moved, right? But what you can fall back on is actually the first principles. So that was actually a very powerful experience for me, and a lesson and a mindset to which then I used and it really helped in my career, right? Whenever I feel, particularly now as an entrepreneur, when I see something that I've never encountered before, I fall back to first principles. So that's one I think that has served me really well. Second, it's I recognize that working in big corporation, working hard is a table stake, but that's not enough. You need to be able to be visible within an organization, right? And communication, and be able to communicate your ideas in a clear, concise, powerful manner is very important. And now it's also very important because you're trying to enroll people that you hire into your vision as well, right? So I really honed my skills during my MBA at Harvard, where actually 70% of your grades depends on how much you speak in class, right? The first 2 months, I just kept quiet because I listened to the Americans and the British speak, and I'm like, wow, they sound so intelligent. But after I got to know them, I actually realized that, from a knowledge standpoint, I know as much as them. So I spoke up, and I really honed my skills in terms of be able to speak on the fly, to be able to construct my ideas in a clear, concise manner that it's enrolling as well as convincing. So I think that's the second thing that really has served me well in my career. Third, understanding the power of network, right? So after I left Morgan Stanley and I got a job with a client, the Chicago Mercantile Exchange, as a client to public. The reason why I got that job was because I spent a lot of time with the client during the IPO. And it was the chairman, Terry Duffy, who's still the chairman now, who extended me a job offer in the middle of the roadshow to join them and to help them break into Asia. And that wouldn't have come up if not for the fact that I met the chairman, right? So I understood the power of a strong network. And fourth, it's really being able to get along with people from different cultural background and different perspective. Just using the CME example again, when I first met the chairman, at the time when we were going on the roadshow, literally Morgan Stanley were laying off people, so they lay off my boss. So I went on the roadshow alone with the client. This is a Singaporean boy who's never lived in the US. I have nothing in common with them. Yeah, and I play football, as you said. They play a different football. There's clearly no overlap and so on. But I managed to be able to forge a relationship with them because of active listening, being able to listen and being sincere and being genuinely interested in their lives. And people can pick that up, right? And building the trust along the way. And I found that ability to listen and be sincere has served me well throughout my career. So I'll just say that those four elements are the one that I picked up, my time overseas and so on. Yeah.
I think it's interesting because in Singapore, of the four, the last three, meaning communication, the network, and the cross-cultural communication, being in Singapore, that naturally inclines you to that. Because one, for example, we're multiracial, we're quite ethnically diverse, we have a lot of expats coming in. So just by the nature of our demographics, I think you are naturally more in tune to being maybe more cross-culturally able to communicate. I think in our schools now, they're encouraging a lot more with regards to communication. And I think Singapore just being a finance hub itself means we are naturally quite well networked. But the first part, I think the first principles thinking is something that I wanted to double click on because I think this is something that maybe has not been emphasized on maybe in your time and my time in terms of education. Like what is first principles thinking? So I naturally would want to come back to you and ask you, in your time as a founder of a VC firm, as an investor, or even in your time, your 20 years in the corporate world, like when was one example where you felt like this first principles thinking was really crucial for you?
For example, the decision to go to business school, right? Most of the peers I've spoken to, they say, look, I want to go to business school because I want to learn something. I want to transition my career and so on and so forth, right? But to me, those are not good enough reasons. It's 2 years of business school with the fees and expenses and the foregone earnings. It's pretty heavy investment. And in that 2 years, honestly, there's nothing better than on-the-job learning. So those reasons didn't quite stick for me. So I thought about it from first principles up. And really, what got me to decide to go was actually I knew the power and the importance of a good network. And I went for that particular reason, right? Now, fast forward to setting up Tinmen. Similar. We looked at what has transpired into what has transpired in the ecosystem then 7-8 years ago. We deconstructed, the ecosystem, look at the trends, and then figure out what are the drivers of trends. And then on top of that, say, okay, we see these trends. Why are other people not seeing these trends? Because there's something to be learned when you look at why people are not doing certain things and try to understand from their perspective. Then finally, when we isolated those, we thought about, essentially, my co-founder, Muli, and I, is there a fit between our experience and what the ecosystem needs? And I would say, given the results we produced, that first principle thinking worked. And every year we revisit that. So those are some of the examples I can think of, in terms of first principles.
So before we go into Tinmen and before we dive deeper into what kind of thinking that inform your decision making, I wanted to go back to your time at Trafigura, where you were actually, I think, the head of APAC, and then you were in charge of doing all the M&As in the region. You were given a chance to be promoted. So you essentially, I think you probably earn, I've spoken to some friends in the financial sector. I've asked, hey, what's the ballpark? If I was in this position, right, you would have been handsomely rewarded, right? And at that point, you were given this chance to be promoted and you were given this chance to earn a ton of money. I think the kind of money that I think most Singaporeans would dream of. So naturally, most people will just take their money, take their promotion, and then move on with their lives. Why do you choose to say no? And not only say no, but quit and then start out on your own VC firm?
I think my mom will say you itchy backside. That happened around 2016, 2017. By then, I've been thinking about it for a long time, right? More pondering, I've done, by most standards, pretty well in my career, especially a boy who grew up in a one-bedroom Toa Payoh, right, whose parents never went to college and so on. But deeply, I wasn't fulfilled, right? So I've been thinking about it for a long time. And that got me to see that part of the reason why I've gone down this path was I was chasing money. I mean, there's no shame in that because, I didn't come from a well-to-do family. It's important that I have money to support my family and so on. But I guess a few things happened. Enough years have passed where that feeling continues to exist, right? And there are days, trust me, where I try to convince myself that why can't you should be happy. Why can't you be happy, right? It's a much easier path. And that accumulated also to a time when a life-changing event happened. My dad passed away unexpectedly in 2016. I think that it's a cliche, right? You start valuing cliches like life is short, right? But only when you have an event happen to you like this that you truly appreciate and internalize that. And it got me, that motivated me to start thinking really hard, right? I turned on the promotion because I think it was the right thing to do, because I didn't want to take the promotion and then have the risk of actually leaving. And I think it wouldn't be right for the people who supported me, and I have some really great bosses there. So that's one, without actually figuring out what I really wanted to do. And I think along the way, it became very clear what my calling is, right? By then, I was investing in quite a few startups, first by backing some of my classmates from Harvard, helping them break into Asia. I got hooked, Late stage investing is moving numbers around in a spreadsheet. I was getting at 6 a.m. I do calls with New York and LA. All I had was my equity and my investment. I wasn't getting paid a salary. But I love the energy of creating something from scratch, right? So I double click on that. Okay. It got me a front row seat in terms of the developments in Southeast Asia, right? It became very clear to me the next leg of growth for this region is innovation. We've done very well borrowing IP from overseas and manufacturing cheaply and high quality, but that's the next leg. And if we can do that, you'll raise the quality of GDP. It has the potential to be able to impact many generations of Southeast Asians who come, right? And I want to play a part in that for my kids, for this region, and so on, right? And Tinmen is an expression of a vehicle to which you use that to impact this ecosystem. Hopefully, you'll grow it into one which is robust, where you can support future entrepreneurs to step forward and make this a more vibrant society. Even then, I had a lot of considerations, including, money, stature. Am I falling behind? Will I fall behind? Will I fail? I think the moment came when, the heart, the gut, and my head aligned, and that's very rare. And I think that was a signal for me that I'll take the plunge, right?
Yeah. And I actually think that that's really quite respectable, because I look at myself now when I left Enterprise Singapore, my previous job as a civil servant, to work on this podcast. For me, I'm a young guy. I'm cheap in the sense that I don't need much to live on. Whereas for someone like you, you've got so much more, and not just in terms of income, but you also have the status. Someone that was really on track to becoming a corporate leader, right? And for you to leave that behind to start your own thing, I think there must have been a lot of internal dialogue that you had to go through. And I wanted to ask you specifically about the transition into starting the fund, because I think there's some lessons to be learned there. Because you're essentially adopting a complete identity shift from someone that had a whole infrastructure, a whole beast backing you. If you wanted, your receipts done, you had a personal assistant. But now if you wanted to start something like a venture cap fund on your own, maybe with a friend, a co-founder, you have to start with only the two of you. So maybe can you talk to me about a little bit more about what was the first 90 days like when you started Tinmen? How do you feel about about this new endeavor when that dopamine rush has subsided?
I think I would say the dopamine rush subsided probably after 90 days, right? The first 90 days were really excited. The moment I communicated my desire to leave, I resigned twice, right? Put in context, these are bosses of mine that have great friendship and they end up investing in the fund as well, right? So letting them, handling it properly so that they have transition and so on was important. So that was done. I felt really good. I was really excited, right? 90 days is on. I think after that, despite having this dialogue with my wife, thinking about cash flows and so on before taking the plunge, I think nothing really actually prepare you for entrepreneurship, right? So I'll give you an example as simple as my son fell ill, went to the clinic, got the receipt, and I received the receipt. It dawned on me, I have no one to pass it to, no corporate insurance, I'm on my own. A simple moment like that shook me, despite it wasn't a big amount, right? But it's like, yeah, you're on your own now, right? Two, if you want to make an overseas call, you think twice, about the cost. You need a lawyer's opinion, you don't have an in-house lawyer. All of that. I think along the journey as well, it's a long period of you trying to raise your first fund where there's long periods where you don't even know, you haven't raised any money yet, and literally you're burning through your savings. All of that breeds uncertainty. And I had a very uncomfortable relationship with uncertainty. Because I grew up in a corporate culture where all this don't weigh on you, right? Can we keep the lights on? When you hire someone, can we continue to make sure that they have a longevity within the firm? Can we feed them and so on? I had a very difficult time adjusting that, right? And then when we started, thankfully we raised the fund, started investing, and 18 months later, COVID hit, right? And we're doing B2B tech where you're like, how are the founders going to do sales when you can't travel, right? It's a lot of stress, right? And then naturally, sometimes when you hit a roadblock, doubt starts creeping up because our thesis was very contrarian, right? And you talk to potential investors, you're like, what's this B2B thing, right? They don't understand. And it's a constant tussle between having conviction in your thesis versus like, oh my God, am I wrong, right? Because you got a whole space for that. You could be wrong. And then along the way, because of the doubts, you start thinking, look, am I going to make enough for the family? And sometimes other thoughts creep up like, my peers are peeling ahead. How will I be viewed when I go back to reunions and business school? So it's very stressful. I have a very uncomfortable relationship with uncertainty, which obviously now I learned along the way. And I think what helped me a lot was surrounding myself with people who are my tribe, right? My wife, she's been a rock to me. Friends who don't judge you for superficial achievements, like how much money you have, what's your status, and so on. That really helped. The other element is actually, I constantly stay connected with my purpose, which we just discussed. And having that vivid image and connectedness with that vision, including when you asked me earlier why I did that, and when I articulate that, I get connected with that again. That really helped as well. But I also journal every morning. I have a gratitude practice. I write down all the things I'm grateful for. And I realize that happiness is not does not depend on how much money you make or the job that you get or the status that you achieve. Gratitude is the gateway to happiness, right? And also accepting that, and it was very hard for me to accept. In the past, I thought, if I work hard, I will get a certain outcome. And that was a belief that I had. And I have to have that belief because I grew up relatively a very modest family. So I had to believe that if I work hard, I can have social mobility, right? And that has served me really well. But then in entrepreneurship, I have to accept that I'm one small part of a very large world. And a lot of things can happen that can derail despite my efforts. And that was a very difficult pill to swallow. And I did that finally, and accept that the only thing I can control, and my co-founder Muli is very good at that. He reminds me, look, the only thing you can control is do your best, and then be prepared to embrace the outcome. So all of that, I don't think is a silver bullet, has helped me. And when I applied that through the tribulation of an entrepreneur, things turn out well. You celebrate that and you gain more confidence that, okay, this is the way forward, right? But there are times, even recently, where have a setback, and there's times that I just feel like crawling underneath a rock and just hide from everyone. Sometimes you just have to do that and work through your emotions, right? So there you go.
So it's interesting because I think most people think of VCs as very hard-headed, super rational people that don't have these kind of risk aversions. But it's interesting to see that even for someone who is in this space, who has also been in a sector that has been defined by volatility, that you still have to cope with these emotions. I wanted to ask a little bit more about Tinmen, because you spoke about Murli and you spoke about starting a VC fund with him. I wanted to ask how you guys complemented each other in starting the fund.
Yeah. I mean, I've been with him so many years already. I mean, by number of years may look small, like 7 years, But we've been through COVID. We built a business together. It feels, more like double that, right? So it's very hard to see sometimes, what is he and what is me, right? But if I were to break it down, for our strategy actually is some people call it a PE approach to VC investing. Moni's experience predominantly in VC. I had, large cap and PE experience. So from an experience standpoint, we complement each other. So that's one. Second, he's more cerebral, right? I'm more action-oriented, right? I think in any partnership, you need a bit of both, right? But with any partnership, you have to find something to anchor on, right? And we're both very committed to that mission of ours. But what also gels the partnership together, he and I believe in first principles thinking as well, and not be swayed by bias. So we are both actually very open to listening to each other, now by extension to our team, knowing that we may not have all the right answers. And remember our mission, and it's nothing personal. It's about the good of Tinmen and so on, right? And that really, really helped us, I think, in terms of working out differences. And again, coming back to listening, being able to listen, and so that you understand where the other person is coming from, so you actually have a good chance actually working things out, right? So I think we found a happy balance between that and a way to anchor the partnership to work out differences through ups and downs. Right?
Yeah. And when I look at the fund thesis that Tinmen proposes, is that you are a venture cap fund that focuses on Series A, B2B tech startups, and in Southeast Asia. So when you write a thesis like this, it implies a lot of constraints. There's like 4 components in there. So there's 4 conditions that you have to satisfy in order to get investments. Naturally, that narrows down the total number of investable companies in your universe. Can you take me through why do you arrive at this angle?
So when Muli and I met, first we realized that we had common values and we had common background and a common way of looking at things and a common mission. Only then that we are both satisfied that actually we're in this for the long haul. Then we started looking at, okay, first principles up, what can we observe about the ecosystem? And these are the following observations we made. Number 1, Southeast Asia is growing. Second is a fragmented market. Third, there's no regional IPO market to support large exits. We also observed that a lot of the money has been pouring to B2C. And from our own analysis, we looked at the deepest market for B2B and B2C rather in the US. Over the last 20, 25 years, B2B has consistently outperformed B2C by 50 to 150%. And the sub-trends that we see from within Southeast Asia is that there's a need for industries to digitize. And we've broken it down to a few drivers. One driver is that the cost of labor is going up, right? The availability of labor is coming down. So that and it's natural because we're approaching developed status compared to a few years ago. It results in margin compression. Right? We also observe that a lot of the legacy industries here are going through leadership change, and a lot of them are going to the generation of my age, the 30s, 40s, and they grow up with tech, and they see tech as a viable way for them to improve the business. Right? If you think about it, the dollars make sense because a lot of these industries are capital intensive, right? They're billions of dollars or hundreds of millions of dollars invested in their assets. Tech can improve even by a few basis points in their return on equity or return on assets, multiply over a very large capital base. It's huge dollars. So we see that trend too. We also saw that what we didn't predict obviously was COVID, but COVID now influences a lot of this digitization because it's truncate essentially maybe a 5-7 years process into 2.5 years where now it's a must-have to digitize. Then the other observation we made was the ecosystem here is still quite young. So pools of capital to invest and to support growth at various stages is still quite shallow. Even 6-7 years ago, we were very keenly aware of the China-US tension. And we saw that Southeast Asia will benefit from that because it's deemed to be a neutral ground. So these are observations we made. And the question is then, okay, got it. What is the best way to extract value from all these trends? You look at VC. The classic model to invest in VC in the US, the deepest market, is power law, whereby you invest in a diversified portfolio, expecting 90% to fail and 10% will carry the fund, and the 10% must be very large outcomes. Right? There must be unicorns, hence the term unicorns and so on. But we don't think it's going to work here because it works in markets like the US, China, India because it's one large singular market. And then you have an IPO market to support these large exits. Both elements of that are missing here. And allow us to then hone into, firstly, the broad thesis of, look, let's invest in very capital efficient business that doesn't require so much capital, less dilution, so you don't need such a large outcome. Anyway, end up B2B, because why? B2B, especially software, has high gross margin, 80%, 85%. Each customer generates internal capital for you to grow, right? So you're less beholden to the capital markets like the shock that we're seeing now, right? You don't need a huge outcome because they're capital efficient. They are the beneficiary of the digitization trend. Then if you slice and dice the thesis a bit more, we invest in Series A or pre-Series A because by then the companies will have revenue, they have few customers, they have a product ready, they hit product market fit. There's a lot more information for us to diligence, and from a risk standpoint, it's more mitigated. We invest in companies that serves legacy industry in Southeast Asia. And what are they? They are construction, manufacturing, agri-tech, shipping logistics, and so on, supply chain logistics. These are the big drivers of GDP. And you think about it, it makes sense. You want to develop a product that someone will buy, right? We have a focused portfolio. We have conviction investments. Fund 1, 7 companies. Fund 2, we're targeting 8 to 10. And that's very tight. We take high ownership, but we work with the founders that then crack Southeast Asia together. And it works well also from an exit standpoint. We're seeing exits actually through M&A. So 50 million, 200 million exits where a lot of strategics want to tap into the growth of Southeast Asia. So to give you a sense, if we exit a company at 50 million, we'll probably make 4 to 5x on that company. And if we exit 200 million, we'll probably make 15x. So far, we'll be able to achieve 90% success rate. So we basically inverted the power law. So on a weighted average basis, you can see how we can deliver anything between 3 to 5x net to the investors. So that's how we've been through the thought process and constructed our thesis to fit the what we observe. Right?
Yeah. That was like a very great mini lecture on first principles thinking applied in venture capital investing and then within Southeast Asia. I thought it was interesting because I think in the US, Peter Thiel has this view that you invest in companies that you believe can return your fund size. So his view is that that's the constraint because you are a venture capital. The nature of it, he says that it's not necessarily that you make loss on everything, but it's that the return of that one big company will dwarf or outsize the rest. No matter how much they make, there will probably be 1 out of your 10. And what's interesting about you two, I think the similarity is that you make a case for having a concentrated portfolio. So then the question I have is that given that you only have in one fund invest maybe in 9 companies to 10 companies, what are the criteria that you use to kind of look at the companies that you're going to invest in? So given the fact that they maybe check off all the boxes that you previously stated in your thesis, what would be the other things that you look at in order for you to eventually put the check out for them?
Yeah, good question. So I'll just touch on a little bit more of the high level, then I will go down. This is the high level which I missed, right? The other element about B2B is that it's not winner takes all. You can have a few B2B players that share the market share and still make a nice business out of it. Unlike B2C, where a lot of dynamics is winner takes all. So you run the risk of, if you don't back the winner, you're going to lose your shirt, right? So that's why B2B, from a risk-adjusted standpoint, is attractive, right? Now, obviously, you say, you have a tight portfolio, how do you make sure? So we talk about capital efficiency, we talk about not winner takes all, we talk about the stage as well. Versus, earlier stage where there's no product, it is really, a piece of paper. Now we talk about how do we look at each investment. I mean, we put on 3 lenses: market, product, and founders. It's very rare you get a tick mark for all 3. It's very rare, right? And if it is all 3, it's probably not going to be cheap from a valuation standpoint. At early stage, we prioritize market and founders. Yeah, strong founder in a mediocre market, you'll get a mediocre outcome. So market which trumps, right? You have a weak product, but a strong team, they will figure it out. So that's why we prioritize market and founders. We spend a lot of time thinking about what are the type of founders we want to back, right? And every year we refine our thinking around that. And a few qualities, it's a long list, but I'll just elaborate on a few. Some of the traits we look for is that we look for founders who have conviction, but loosely held. To start a business, you got and not take a job, and to go down the less trodden path, you got to have conviction, right? But at the same time, things change rapidly, especially in the tech world. We like to see founders that when confronted with compelling data, are willing to change their mind, right? And that's a crucial trait to have, because you will have different challenges and new information as you scale and as you go to different countries. What holds true for Singapore may not hold true for Malaysia or Thailand. Yeah, so it's one that we look at. We look for founders who have a growth mindset. And a growth mindset is important because as you scale from pre-Series A, Series A, and where you have a small sampan, you become a Series C or D where you are steering a ship, right? Where you have people, you hire people and so on. You're going to have to grow as a person. Being willing to grow, either to become a better manager, a people's person, a better coach to your employees. It's a crucial trait to have, right? Third, we look at curiosity. Are you curious about the problem? Are you genuinely interested in what the customer is facing, or what are the threats to your business? Having that curiosity throughout their life is an important trait, because it means that you are constantly thinking and having your feet on the ground. So those are some of the traits that we look for, and we try to tease it out of the founders. Now, there's another trait that I should just mention, is grit. Right? Can they pick themselves up after a hard knock? Right? Have they gone through adversity before and picked themselves up? So yeah, those are some of the things that we look at. Market, of course, it needs to be a sizable market, willing to adopt digitization, have the ability to pay, and so on. Yeah.
How do you tease some of these traits out when you look at or when you assess these companies? Yeah.
So let's pick the one on conviction but loosely held, right? When we understand the business a bit more, we will pull up data about the industry or any topic relevant to that startup, and we'll sit with the founders and say, here's the data that we found. What do you think? Or some version of that question, I'm not sure what you believe is correct, and see the reaction. Doesn't matter whether my data is correct or not. I mean, of course, we try to put correct data inside there and prove a point. But do they actually, first reaction, look at the data with curiosity and willingly to learn, or do they just brush it off completely, right? That's one. And if it's data that's compelling, do they actually have the maturity to say, you know what, you're right, I'll rethink this. And put this in context, right? They're trying to raise money from you. And to be able to admit they're wrong, it's not easy. But it shows maturity. So all that is ways that we can tease it out, traits in the founders. Yeah.
I always think about a founder, the popular imagination of a founder is someone that's almost like stubborn to a fault. So the fact that you actually are looking for people that's the opposite, and you have that qualifier of having strong convictions but loosely held, I think that's something that I think would make great founders within like not just Singapore, within the region. And you think about the great leaders even in Singapore, I think you see some of those examples especially in policy. So I think one example was when Lee Kuan Yew had that graduate mother scheme. He brought it through to the parliament. He thought that was the best policy that would help with improving our birth rate. And then when he realized there was such a huge backlash, he relented. So there is a sense that you must know when to pivot and when to make that change. Actually, you hear a lot of cutthroat stories where maybe some of the VCs completely disagree with the founder, and then they just yank the company in the direction that they want instead of what the founder's maybe original direction is. And there is a tension between the venture capitalists and the startups, because usually you might want to have your liquidity exit. So my question to you would then be, how is the relationship between Tinmen like with your startups?
Our approach with our founders has always been to build the trust between us and them. That they see us as someone who could be trusted on to do the right things when the time comes. And you speak to founders, they understand the importance of that. Having a bad investor on board is like you're driving in a race car and you have a punctured tire, right? Having a good investor is having a co-pilot next to you. You're still steering, but you have a co-pilot that helps you orientate and so on. So we strive to be co-pilots for them, someone they can trust on. So we built that day one when we first meet them. And one of the things we tell them as well, when we wire the money across to them and the cash hits the bank, the first conversation I tell them, a lot of founders, is that the money's in now. From now onwards, don't just tell me the good news, please tell me the bad news as well, right? And how we see that from Tinmen perspective is be constructive. It's never a straight line. Things will go wrong. And when things go wrong, are you going to blame them? Kick up a fuss? Or you be constructive and say that there's a problem here, let's all fix it together. And I think just showing up when they need us through ups and downs, regardless of whether it's boom market in VC versus non-boom market, or whether that company is performing or not performing. I guess also our strategy aligns with that, because when you have a tight portfolio, if one of them fails, it's going to hurt. So we're very aligned. So at a very high level, that's the kind of relationship we want to have with them. And when you have that trust going, both parties can be very candid about their motivation and wants. And sometimes they conflict, but at least when you have that trust, you can start discussing it openly versus hiding your true motivations, and you have no chance when you hide of solving it. And that has served us well in most circumstances.
What do you think about venture capital today that is broken? One example that it comes to mind is like the closure of Flash Coffee in Singapore. Because I thought for a very long period, there was a huge, everyone was trying to get in on the game. And then suddenly in one day, they essentially closed down everything in Singapore and they evaporated in Singapore. Part of me thinks, that's a huge opportunity cost in all the capital that have invested in there, because at the end of the day, they withdrew from the market. So we didn't extract much value from it. And also the second thing was there was an analysis done, I think, in the past year where they were looking at, part of the factors, some of the factors that were leading us into this VC winter. And one of the ideas was that some of the VCs were immature and they were investing in incremental ideas. So then it made me question, is there something wrong, or is there something that we need to improve on in the VC ecosystem in Singapore?
Yeah. So it's very unfortunate. I think Asians in general are enamored by what happens in the West, right? And that, I guess, permeates our culture. We grew up watching Western movies and so on, and look, it is for example, US the deepest market, right? Definitely for VC, right? And I think unfortunately, over the last 10-15 years, a lot of the investors and founders have emulate what happened and what has worked in the West and just copy and paste it here, right? I think there are a lot of good things that you can learn from there. But you have to learn from the lens that does it actually apply to my circumstances. You get advice, you should also view it from that standpoint. Power law works in the US. We talked about that because it's a very different market, because it's a deep market, it's a homogeneous market, it's got an IPO market that supports large exits. It's missing here, right? So applying that style of investing in a fragmented market, it's not the right strategy, and to put it very lightly. Because we are a large market collectively. To build a large company within your fund life, the probability is low. Finding a large company is low in a deep market, let alone in a fragmented market. And then when you find one, how are you going to exit and return cash? So unfortunately, it's a shame that we have the approach has not been catered for the uniqueness of our Southeast Asia, and billions of dollars have been invested along the way. And it's a shame that if it was done slightly differently, we would have been a very different ecosystem now. And you look back at it, the math is very obvious. If you raise $100 million fund, you need to make at least 3x, right? It's 300 million. In a diversified approach in power law, after dilution, so when you exit the company, you own about 5%. That means, you need $6 billion of exits. You raise a $300 million fund, it's 18 billion. In this current state of development, do you see that kind of exits? No. So the math is actually very obvious if you took the time to do it, right? Now, where do we go from here, right? I think it's an opportunity, for us to reset. Now, the Silicon Valley wasn't built overnight, right? We got to take this on our chin, use this reset to recalibrate. Fund managers, founders alike need to think about a way to invest and grow businesses that suits our region. Have the confidence and the audacity to do things differently, but because you know it will work, because you studied and you understand the market. Now, going back to first principles.
Yeah, I think there was also a long time that they believed that there was an exit option in the US IPO markets and that we would do well there. I think there was a very long time that we believed in the hypothesis that you could grow big enough in Southeast Asia. When you list maybe in the New York Stock Exchange, you will probably be seen as an equal to the American firms. But I think that has been proven to be false. And back to your point, you're right. We don't really have the exit liquidity. So I think right now there's probably a lot of rethinking of how VCs should kind of invest in startups. And then begs the question, right? Like, in your view, like, what would then be the venture capitalist value add now in Singapore's ecosystem? In a sense of, other than capital, because we're a finance hub, so naturally when capital aggregates and you have fund managers, you can deploy the capital. But outside of that, right, what else can VCs value add, and how is Tinmen value added to your startups?
Yeah. So we talked about how Tinmen, earlier in this chat, how we want to be with our founders, to be the trusted investor. They will do the right thing, right? That they can come and communicate good or bad news. I think doing that, as I understand from speaking to a lot of founders, there's a big step forward, right? Just being there. And if you're not helping, don't get in the way, right? I think a lot of founders would like investors to approach it that way. Yeah, building a business is hard. They don't need people bringing down their neck unconstructively. The way we approach value add, and I will caveat that we are still learning as we grow as a firm, right? We're not a very big firm, so resources are constrained and so on. So we speak to founders and understand what needs they have. And we talk about how the ecosystem, the capital stack is not as developed. Raising money and finding the right investors is actually quite hard here, right? So what we do is actually we have, in a few cases already, help them gather up, in some cases lead, negotiate with investors and help them complete the round, right? Thereby freeing the entrepreneurs time to go focus on the business, whilst, for example, me in this case, I've done this a million times, so I know the documents by heart, right? And to, I guess, herd the cats and get to an outcome. So that's one. We have built up a set of investors who are strategic into our fund, and they have purchased the products of our startups, and through that become their first, perhaps, anchor customer in Malaysia. So, Dialogue Group is one of our LPs, and with a Dialogue Group logo, our startups can then say, okay, Mr. So-and-so at Malaysia, Dialogue bought from me, right? So I have credibility, and then you grow from there, right? We have put together some very valuable resources. So we have this initiative called Blocks, where we pre-negotiate a lot of service providers like fractional CFOs, fractional go-to-market specialists at a discount rate, pre-vet them, and make them available to not just our own startups, but, companies we don't back as well, right? That saves them time, but also gives them the access to cost savings and so on. So these are some of the ways that we do that. We are constantly evaluating what do startups need and what is the best way to go about delivering the value. So, for example, one logical suggestion would be that once you hire an operator into But we invest in construction, we invest in people serving hospitals, agri-tech. How do you find one person who can handle all of that, right? And a lot of the advice is only as good as that it applies to a particular business. So we're mulling over there, and so far we think the best way is to actually work with a group of agencies that can provide this, and in industries that suits the particular startup, right?
So in that sense, actually, you help the LPs dog food the startup's product. I think that's one of the things that I've learned from today. Because I think a lot of startups, or at least when big corporates launch new startups, they actually dog food their own product, right? So in your sense, actually, you actually help the startups get access to the LPs as customer. And I'm sure it will also help you with your strategic M&A as an exit option as well.
That's right. I mean, some of them could be natural buyers for it as well. Yeah.
So it's very interesting that you have this very different view of how venture investing should look like. And that could potentially spell a new future for Singapore. If you were an advisor to a policymaker here today, because I think Singapore, a lot of our industrial policy is shaped by the government. And if you had to advise them, on how we could make Singapore the place of the future, a home for the future, a place where startups that are looking to build the future of Southeast Asia would be, what advice would you give them?
I think we grew up in a generation, at least for me, where don't worry, government will take care of it, right? I think, sure, but I don't think you get the most effective solution. And I certainly don't think you get the best out of Singapore if we had that thinking. I think the best solution comes when there's a collaboration between policymakers and the private sector. That's why we're working very closely with some of the policymakers as well. I think for startup and for this ecosystem to thrive, I think it's important to have a well-functioning capital stack. What do I mean by that? It means that you look at the US, they have angel investors, they have seed, they have pre-seed, seed to Series A to B to C and growth, and and then when companies exit, the capital is then redeployed back in the system. It becomes a perpetual motion, right? We need to build that here, right? And I feel that whilst there were earlier efforts from Singapore government to seed the first gen VC, right, which unfortunately, as what we discussed, has produced mixed results, that effort needs to continue. Because speaking from my own experience, raising money from here, it's very tough. Because the pool of capital who truly understands VC is very shallow. Despite all these family offices that has flocked here, I'm not entirely sure how much of it is actually invested versus consumed, either in a nice flashy car or a big house. So then the next natural choice is to go to markets like the US to raise. It's possible. And there are investors who are interested in Southeast Asia, which we have found and secured as LPs. But it's very competitive because in their minds, I have the choice to invest in the US market, which is the deepest, most liquid market, versus Southeast Asia, which I know very little about. It's still an uphill task. So I do think initiatives by government to continue to seed the next gen managers who have the right strategy that is catered for this region would be extremely helpful, because if you get someone like Singapore government investing in you, there's a multiplier effect, right? You have a Singapore brand and you can go out there and raise a lot more capital. So you're actually helping bring capital back to Singapore as well. And there are other programs like the GIP program from EDB, where selected, the pool of money comes from folks from overseas who want to, make Singapore their home. And some managers are deemed to be qualifying investments as a criteria for them to fulfill their desire to get either PR or citizenship, right? The last one was, I would say, selection was veered towards very large managers who have managed at least 1 billion AUM. And I feel that initiatives like that could be better channeled to emerging managers, right? I think some of this element will be extremely useful and needs to continue to happen if we still decide that we want to build this ecosystem out. Second is exit, SGX. Now, our fund doesn't rely on IPO for exits. But exits, the more viable options you have, the better. So SGX, I'm glad to see that some efforts, some desire is there to turn it into a viable exit for tech companies. I think that will really help as well. So those are some of the things that I can think of that would make a meaningful impact working actively now with policymakers to give feedback and also to help play our part, right?
Last question, which is you have to give a piece of advice to a fresh grad entering the workforce. What would it be?
I would say experiment as much as you can. Try different things. Only through that you figure out what lights you up, right? And do that early. It took me many years to figure it out, and a lot of my peers go through the same thing as well, and still haven't figured it out, right? You figure that out, even though you can't action on it at that point in time, but it's a huge lift because then you have time on your side to then work towards that. I'll give two advice. The second advice is have kids early, and I'll explain why. Right? My parents were telling me you should have kids early and so on, but my focus is that I want to build my career right now, right? But if I think about it, actually, if you want to focus on promotion, impact, and the monetary gains you can make, the impact is much higher when you become more senior in your career, right? I had kids late at a time when I was really quite senior, right? If you had kids earlier and they grow up, and then you can focus when you become more senior and you get much more impact from a career standpoint, right? Of course, I don't tell my parents this. I don't want them give them the satisfaction. They say that they are right, but yeah, those are the two advice I'll give. Yeah,
experiment and have kids early.
Yes.
Thank you, Jeremy, for coming on.
Thanks, Keith. Glad to be here.